Thank you so much, Anna. Welcome, everybody. I have such a long-standing connection to TB Vets. It's just so wonderful that Anna and I reconnected a while back. And thank you, Candace, for sharing some of the wonderful work that TB Vets does. It's just an amazing thing in our communities. And I hope today, with Anna's support, to provide a clear and focused message around 3 specific legacy planning tools. If anyone has any interest in viewing or reviewing my slides afterwards, I can get Anna a copy of the PDF as we've done in the past so that you can study it. And if there's any additional information, although I am not a tax expert, I don't profess to be, I'm not an accountant or a lawyer, so you can rest assured that I won't be giving advice, but it will be information that will be valuable based on those 3 specific topics. And Anna, if anything comes up, by all means, just ask away, and we will have a Q&A at the end for those who have specific questions. And I will, Anna, as before, be making reference to some articles that some of the attendees may want to have, which we can make available after the session today. So enjoy, and I hope you can come away with something that you find of value. So when we think about the fact that, let me just going to make sure that my slides are going to advance here. There we go. Every Canadian has a legacy. You know, the interesting thing is it's as individual as the person. So as you go through this, just think about what yours is, because there'll be a couple of different ideas for you to consider. And sometimes people have it set in their mind that there is only one way to do things, but there are a variety of different options. And I personally feel that regardless of age or circumstances, it's something that we should all consider. Now, this is probably one of the most interesting definitions of a proper estate plan that I have ever seen. I've used it for years. And when you think about it, how can a person maintain control of their assets while they're alive, take care of themselves and or their loved ones if they become disabled, give to whom they want, when they want, and make sure when their estate is distributed that there is the minimal amount of tax, any probate and court costs, maximizing your hard work, maximizing what you have generated over your working lifetime and what you want to pass to the next generation and to your charitable interests. So for discussion today, I'm going to cover off each of these in their component parts, and some of them are connected and some of them are not. So as we go through it, if you think of any questions or anything comes up for you, just save it for the end when we get to the Q&A. So I'm going to start with the bequests in a will. I don't know, Anna, if you have seen this chart from the Canadian Association of Gift Planners Foundation. I have a variety of financial and charitable connections in my industry and in my community, and attended one of their advocacy webinars a number of months ago. It's just part of my ongoing development. And I just found it really interesting to share, because it really walks us through this initial topic, the path to increasing charitable gifts and wills in Canada, what actually is happening. I found it really amazing. And I'll just go through some of the highlights, that 5% of Canadians creating a gift in their wills should really be a basis to leap from. And if we walk through some of the data that they've gathered, nearly 90% of Canadians have a will by the age of 75. And 86% of Canadians know they can make a charitable gift in their will, but they're not really sure whether that is the right way to do it in their will. They don't feel that they have enough information, because if they do leave a legacy to the charity in their will, that it might result in less being there for their loved ones. So there's this misconception there about that. So hopefully we can address that in this little part of the presentation. And 1/3 of Canadians are interested. They're interested in giving to charities. They want to help, but they may need a bit more guidance. And of 62% who are interested in giving it serious consideration, a couple of roadblocks. that generally between clients between the age of 65 to 74, they're just not sure how they should be naming that charity in the will, and that they're not sure how to talk to their family about it. So I found there's the full legacy report can be downloaded. I'm happy to provide anyone with, I'm kind of like a research junkie. I love to see how things have evolved and how things move. And I thought that was a great visual just to communicate that it's such an important topic. Mm. Now, this was another interesting piece, and this is from the Foundation for Philanthropy of Canada. And apparently 55 plus are the most likely to leave a gift in their will. And ages 18 to 34 are significantly more likely to leave physical investments or financial assets as opposed to doing the will. So probably tells you who's not got their wills done. But this is another very interesting piece of information on the age groups that are more likely to name a charity as a beneficiary based on their age group. Different groups have different approaches, just like the different cohorts we have all come with a vast array of experience based on their own life experience. So let's just move on to that, leaving a gift in the will. There's just some data points to go through. Very important to think about when your will was last revised or redrafted. Now, the estate lawyers that I have worked with in the past have told me that the will should be reviewed at least every 3 to 5 years. And of course, if there's any changes in a client's situation, might need to be revisited more often. I was on an estate review meeting through my employer this morning with a client in Ontario, and we reviewed her will, and it had not been looked at for a number of years, and she was quite surprised at what was still in it. Saying, oh my goodness, I've got my husband named as executor. He's 15 years older than me and has health concerns. I think I need to revisit that opportunity. And albeit that there's not charitable inclinations yet, there is an interest, and adult children with different needs, some of them financial, some of them otherwise. So very good exercise to be doing that in the first place. And one of the things is, as a follow-up to that first slide that I showed, are your other beneficiary interests balanced with your charitable intent? That's always what will come up with the will review. And, as you mentioned, Anna, it could be a multitude of charities, doesn't have to be TB Vets. I guess for the purposes of today, I'm privy to TB Vets, so I've got TB Vets listed here. I hope that's okay. But has TB Vets been clearly identified in your will along with the amount of the gift? And Anna, I'm sure you have conversations with donors about this in terms of, is it a percentage? Is it a dollar amount? But it's very important that that be very clear as it's stated in the will. And how are you going to accomplish that gift? Is it going to be a cash legacy? Is it a donation of property or other means of gifting that we may explore a little bit further in the presentation? And one other thing that has come up, I'm not sure if you've run across it, Anna, but I have seen this and it is a consideration. Perhaps you have created a testamentary trust in your will. Let's say it's in favor of a spouse. Perhaps the trustee, when that spouse passes away, there could be the intent in the trustee document to make charitable donations from the capital that's remaining in that trust. So you can see how sometimes there's lots of little variables that can come up when you're reviewing what terms are already there to expand the charitable giving legacy opportunity. Now, some additional factors from a tax perspective, and I purposefully did not get technical here, Anna, and towards the end of the presentation, I've got some tax considerations just to update everybody on, which is why I offered to have the presentation available as a hard copy for you to provide. But one thing that's important to know is that there's no tax savings when you have the legacy in your will. There isn't a tax savings to you during your lifetime, right? Because when does it go into effect? It goes into effect upon your passing. The tax benefits, when they occur when you've passed away, will of course depend on the donation rules at the time the gift is made. And assets are not donated to the charity until after you pass away. So you don't really get to witness the benefits of that gift because it happens at the time that the will is executed. And if your financial situation changes, the size of the bequest that you've provided for in your will may need to be adjusted. So for example, what I have found is if clients have a care need in retirement, and they may have to dip into certain assets to provide that care for a loved one or themselves. And depending on how the legacy is structured in the will, that's why it's recommended to have an ongoing revisit to your will when there is a charitable gift made in it, to make sure that it addresses any changes in your situation. And in all cases, we recommend to all of our clients to consult a tax planner to ensure that they're properly planning for the gift that they want to make and maximizing the tax benefits, whether those tax benefits are much better appreciated while during your lifetime or upon your passing. For example, if there's a significant tax liability that might be expected in the terminal tax return. Tax reminder, a final return must be prepared by April 30th following the year of a person passing away or 6 months after death, whichever is greater. And in the terminal return, so there are the two returns, in the terminal return, the deceased can claim charitable donations made during the year, and those specified in the will or in a life insurance contract by a beneficiary designation with a 1-year carryback. So that's just a final summary on the will legacy. So donating securities. Now this is interesting. This is an amazing way for clients to turn investments into gifts and not have to pay any capital gains tax on appreciated stocks or securities. That could also include segregated funds with an insurance company. And this is one of the most cost-effective ways to donate to TB vets, for example. So your gift of securities entitles you to a donation receipt for the full market value. In other words, the resale of that contribution, which results in a non-refundable tax credit that can reduce your income taxes. It does not give you a refund. Non-refundable means it can reduce the amount of tax payable. And you can use it in the year of the gift or carry it forward for up to 5 additional years. So I've got an example in the presentation to walk through. So this is a little mini chart comparing selling your shares, selling the securities and giving the net amount of cash to TB vets as an example, versus gifting the shares to charity. And I have a question for you at the end, Anna, regarding TB vets process, but we can walk through the example here. So let's say we have a client with $10,000 in value shares, current fair market value, that they want to collapse and give the net amount to the charity. And let's assume that the cost base of the shares is $2,000. So that means that there is a capital gain to the extent that the fair market value exceeds the ACB. So we've got 10,000 minus 2,000 gives us 8,000. And assuming when the tax comes, I think it's next week, there's a ruling coming down regarding the 50% versus 75% proposed capital gains inclusion rate. You know, I was talking to a tax accountant friend this morning. He says, I don't know with this high inflation whether that would fly very well. So let's hope and assume that it stays at 50%. Mm-hmm. So in this circumstance, the tax on the capital gains would be $1,840. The donation tax credit would be the 8,000 at, let's say, the tax rate, a high tax rate of 46%. So the net savings from making the donation in that way is $2,760 versus donating the shares in their entirety to TB Vets. Same calculation, $10,000 fair market value or proceeds of disposition, the adjusted cost base of $2,000, capital gain of $8,000. But look at this. What is the tax on the capital gain? 0. The donation tax credit of $4,600, but the net tax savings from the donation is $4,600 versus $2,760. Now, when a client undertakes this transaction, Anna, there is obviously a process that TB Vets has in terms of documentation. Important. I don't know whether you just want to touch on that, but it is something you would work and partner with TB Vets on to enact that transaction.
That's right. We have a process, and I can share the information with our participants.
Perfect.
It's a very simple form that the donor fills in, and we give it to our investment company, and they take care of it for us. So it's all sort of ready, and easy to use.
Mm-hmm. And I think that having this advantage, one of the things that's important for clients to think about when they're considering this is just taking a look at their overall retirement plan. Because to make sure that they have enough money themselves and what each of their asset classes will be used for, because it's just like making gifts of anything or even giving a gift of cash to someone. Once you've made that gift, it's kind of hard to reverse it, isn't it? So it's really important to think about the impact on your overall financial plan when you're undertaking this decision. So the third thing that was on the list was the donation of insurance. And there are several ways. There are actually 4 different ways, in fact, 5 different ways. I've got a nice new one. I don't know if you've seen it, Anna, but I'm going to share it with you, with everybody. But you can actually make a significant gift even if you have limited resources. So, for example, let's say that you look at the value of your estate, you look at the cash flow situation that you are in, and you've maybe been making donations wherever you can, but you really want to make a significant gift and you want it to be private. First of all, is the will a private transaction? No, because under the Wills Variation Act, a will can be contested in the province of British Columbia. So when you use life insurance as a way to make a gift, it is extremely private. And you can make a relatively large donation when you pass away in comparison to the actual cost of the insurance. So again, this is a very personal thing, and it is something that has to be done for each individual person. Because if you're using a brand new life insurance policy to leave a legacy to TB Vets as an example, it does require underwriting. And I'm going to tell you about that when we get to that section. It results in a non-refundable tax credit that can be used either during your lifetime by you personally and your estate when you pass away, depending on how you set the gift up. And from a charity's perspective, from TB Vet's perspective, receiving a donation as the beneficiary of a life insurance policy, let's say you have an older insurance policy that doesn't fulfill the needs that it had in the past, and you can change the beneficiary to the charity, it's easier and more certain than from an estate where there might be potential liquidity issues, creditor claims, litigation, other assets tied up. Sometimes estates can take a while to settle. And I have Anna some reference documents on the information that I'm going to share, so that everybody can read through the different parameters and how they work from a tax perspective and benefit for your lifetime or when you pass away at the estate level. Now, this is a great article. I follow Tim Sesnick. I used to work with Tim Sesnick years ago when he was a consultant at Berkshire Investments. We partnered together on a lot of estate planning opportunities for our clients at the time. And this is a recent article from, I believe it's 2021, 2019, 2021, one of the two. I've been looking at a number of articles, but this is one where he talks about the creative ways to use life insurance to benefit your favorite charity. And, you know, I would say, you know, I can remember years ago doing a presentation for Ducks Unlimited. And they happen to have their annual meeting in Vancouver. I think they're based in Winnipeg. And I talked about this particular opportunity, and the director came up to me after the presentation and said, you know, we need to have more information on this for our donors. This is one area that is often just overlooked or unconsidered, just maybe lack of information or lack of where to go or what's the best way to structure it. But it is such an incredible opportunity for people to consider. This is a great little piece that he's written that you can just Google it. You can get a free subscription to Globe and Mail online, and you just Google this article and you can get it and you can read it. It's fabulous. So many people say, if you want to know something, just Google it, right? That's all I seem to hear. So let's look at just some two of those and the common ways that they work. And LI stands for life insurance. Okay, so life, and I don't like acronyms, so I always like to tell people what they mean. Life insurance plans, two common ways that they work. The first way, you purchase a policy and you transfer the ownership of the policy to the charity. And whoever is the owner of the policy, in this circumstance is the charity, has to be the beneficiary. So your life is insured, the owner is TB Vets, and the beneficiary is TB Vets. Immediately you get a tax receipt for the value of that policy when it's donated to charity. And the tax receipt is for the premium payments made on the policy. And I'm going to talk about some of the parameters with respect to that. So it becomes an asset that's owned by TB Vets. And each year, TB Vets would provide you with a slip for tax purposes equal to the amount of the premium. And when you pass away, the policy belongs to TB Vets. The other way is where you have an existing policy or you take out a new policy where you remain the owner, but the charity is the beneficiary of the policy, and therefore the tax benefits arise when you pass away. So you being the owner of the contract can change the beneficiary anytime you want. You're in full control of that, where the first way you can't because you're not the owner. And the tax receipt is as a result, when you pass away, the executor would address the payment of the insurance proceeds to TB Vets. So just to expand on that, to cover off some other scenarios, I know there's a lot on here, but I want to walk through it. So let's say you wish to own the policy and name the estate as the beneficiary in your will. What is the tax outcome? There's no tax benefit during your lifetime. The death benefit is treated as a donation, and there's a tax credit for the full death benefit amount of the policy. And the gift can be made in the will identifying TB Vets or providing instructions to the executor. The estate is named as beneficiary. The gift is subject to probate and creditors, and it flows through the estate. Now, this is the downside of this, is that also the insurance proceeds are subject to probate. because whenever you name an estate as beneficiary on a life insurance policy, those proceeds form part of the estate for probate purposes. So the probate fees are paid, then the executor enacts the gift. So again, as I mentioned earlier, it's so important to consult a tax professional, or for someone like myself or someone you may have as an advisor now who has experience in setting up the insurance policies properly to recommend which one would be better for you. So the second column is where you want to be the owner and name the charity or TB Vets as the beneficiary in the policy. So it's not going through your will. It's where you're the owner, the beneficiary is the charity. There's no tax benefit during your lifetime. The death benefit is treated as the donation. The tax credit is for the death benefit amount, or if there's more than one charity named, which you can do, you can name as many beneficiaries as you want. You could have 50% of the insurance proceeds to charity and the other 50% to your children. And how the designation is made, it's directly through the beneficiary designation, and the gift is made directly to the charity outside the will. So it's not subject to creditors, it's not subject to probate, and it's not subject to being contested. So then the third way is where you donate the premiums, the charity owns the policy and is the beneficiary under it. So it's the premium that's a donation during your lifetime, the cost that you pay for that policy. There's no tax benefit at death. It's a new policy. If it's a new policy, then the tax credit is for the premiums that you pay for the policy. And if it's an existing policy or a policy that you have had for a number of years, there is an actual immediate tax credit if the policy has any cash value, and there has to be a valuation done to determine the policy's fair market value. And then any future premiums you pay on an ongoing basis ultimately would give you that tax benefit from paying those premiums because the charity is the owner of the contract. So you're in control of it initially, you transfer the ownership to the charity, so you forfeit any rights under the policy. And of course, the gift is not subject to probate or creditors. So you can see, Anna, there's some variables with the life insurance that really requires careful consideration.
Yeah.
Is there any existing life insurance that you own? If you're going to take out a new policy, the minimum policy size available in the industry is $25,000 with a major insurance company covered under a Securities, where the insurance rates will never change. You want to make sure that you've got the right type of policy if you're setting it up. And of course, it would involve making sure that there is the health approval to secure getting a new policy. Now this is, I don't know, Anna, whether you have heard of the Charitable Insured Annuity.
No, I don't know anything about it. So
Well,
I'm very curious to learn.
You know, it's interesting because many years ago, I did some work with the Cancer Society. And there was a gentleman that was there, and he had just lost his wife to cancer. And he was actually fulfilling what she used to do as a volunteer to pick people up and drive them to to have their treatments. And when she passed away, he wanted to create something unique in her name. And so I shared with the audience this idea. And he had never heard of it before, and he enacted it. And so let me share with you how this is based on a widower, male age 70. I'm sure that this fellow was around that age. What it does is it provides the donor with an immediate increase in tax sufficient income right now, and allows for a significant donation to TB Vets when he passes away. And what it is a combination of a prescribed life annuity and a life insurance policy. They're used together to implement the strategy. So the first thing we do is we find out if this client, this donor, is insurable. And he has $250,000 sitting in GICs that are probably going to be earmarked to be left for charity. Because every situation is different. I've only put together this model just so that people can have an idea how it works. And you'll see that we're comparing this strategy against leaving the money in GICs, assuming he could get 3%. Yeah, everyone's tax rates are going to be different, et cetera. But here's how it works. So you can see the column, you can see the columns there. On the left-hand side, I'll walk through each of the different layers. In the middle is the GIC comparison from an estate value perspective and comparing it to the charitable insured annuity. Now, a prescribed annuity means that that $250,000 is given to the insurance company that offers the best annuity income with the same level of taxation, because with an annuity, it's like buying a pension. The taxable portion of the life annuity qualifies for the $2,000 pension income deduction and helps to reduce the OAS clawback. So not all of the annuity income is taxable. I'm going to show you in this example. And that annuity income net of tax is used to fund a $250,000 policy that will, upon the client's passing, the annuity stops because we don't need to fund the insurance anymore. And the $250,000 is payable to TB Vets, to the charity of their choice. You can't have more than one charity to do this. You have to do each individual charity has to have one of these. So let's walk through the example. So in both cases, the initial capital used or available is the $250,000. They can be set up for $50,000, $100,000, whatever the client has. We do not recommend that a client put all their eggs in one basket into this strategy, because again, it depends on cash flow. It depends on the other financial instruments that they need to provide their income. So it's very individualized. So the annuity is going to be purchased. The investment rate on the GIC is that it's sitting at 3%, and the annuity, the income that's payable to someone from the annuity, is based on their gender and their age. So the taxable portion varies depending on those two factors. So for the GIC, let's assume $7,500 is the gross income at 3% on the $250,000 sitting at 3%. But look at the income from the annuity, $18,333. Taxable portion of that interest income from a GIC is 100% inclusion rate. $7,500 is the taxable portion. Look at the taxable portion of the life annuity, $3,021. The tax payable, assuming that this widower is in a 46% tax bracket from the GIC, is $3,450 with an after-tax cash flow of $4,050. So the $250,000 is still there, still in the client's portfolio, and the after-tax income is $4,050. With the life annuity, the after-tax cash flow is $16,943. Now, what we're going to do is we're going to replace the $250,000 that was used to buy the annuity with insurance. And that premium, and this is just going to depend on the type of policy we set up, that would vary. But in this example, which is current, $16,943 of, sorry, $10,798 would go towards funding the $250,000 of insurance. So the net cash flow, even after paying for the insurance, is $6,145 versus the $4,050 from the GIC. So what has this client done? They've increased their after-tax income, and they've created a $250,000 gift that will pass on at their death, and they've received a charitable donation credit on the amount of the insurance premium. See the charitable donation tax credit of $49.67, the equivalent pre-tax yield 4.55%, and after the credit has been applied, the equivalent pre-tax yield that would have to come from an alternative investment is 8.23%. Now, when this client passes away, the GIC would be available in the estate to be left to the charity. There is no estate donation credit from the insurance because it's paid directly to TB Vets, because there's been a charitable donation credit taken during lifetime. So see how, depending on what you're trying to achieve, is the donation credit needed now while you're alive to give you increased income, or is it needed when you pass away to offset any corresponding tax liability, perhaps, or to leave that specific legacy when you pass away? So it's a pretty unique way to combine the use of a life annuity, a prescribed annuity, which means that the amount of the taxable portion of that annuity definitely stays the same every year, and the annuity is based on the age and gender of the client. And it is such an overlooked opportunity. I wanted to introduce that as well. Now, if a client doesn't, I don't know whether TB Vets does charitable gift annuities themselves.
Not as far as I know.
Yeah, and so I do, offside, Anna, I do have another tax publication that I can provide to you.
Thank you.
I've partnered with a variety of charitable organizations in the past who have essentially purchased the annuity on behalf of a client from an insurance company, or the client themselves does it themselves. But that's another area. A life annuity is an insurance product governed under the Uniform Life Insurance Act of Canada. And so that's another opportunity if the client doesn't want to use life insurance in this way, or they don't qualify for it. There's always the opportunity for a life annuity. I think life annuities as well are one of the most forgotten opportunities to be able to do planning from either a legacy perspective or an income perspective, unlike traditional investments. And if anyone's interested in getting an example for themselves, after today, you can let me know, Anna, and I can prepare one for them. I can have a complimentary consult to generate an example for their consideration, if they don't have an advisor that can help them do that.
Thank you.
Now, Q&A is coming up. I just had some tax guidelines on here that I wanted to cover off. I don't want to get into the tax. I mean, this is just to talk about up to the first $200, the federal tax credit of 15%. In donations in excess of this will qualify for the top federal tax credit rate of 33%. There's all these formulas and things to be cognizant of. There's also the non-refundable provincial tax credit of between 5.06 and 20.5, depending on that amount over $200. Married and common law couples can pool their donations receipts to maximize the tax credits. And an individual can claim an amount for total donations of up to 75% of net income, plus 25% of any capital gain, taxable capital gains, and recapture of depreciation related to the gift portion of the donation of capital property. And donors may want to defer claiming small amounts until a future year when the amount to be claimed exceeds 200, with the 5-year up to 5-year carry forward period. So there's just a final summary of some tax things that might be important to have in writing if someone's so inclined, depending on the extent of their charitable inclination.